Welcome to my live stream. It is Wednesday, January 24th. The market has closed. The market sold off today. You saw some technology stocks get severely sold off, and I'd like to go over a few stocks that are in that category. And we saw some stocks outside of tech, like in energy, consumer staples, healthcare, really do well today. So it was a good day where we are seeing a little bit of a rotation. It's early in the year, obviously. Overall, I think the beginning of the year is still fairly good. If I look at the year to date for the S&P, we're in the green by 0.56%. We're at the end of the 14th. We've got more than half of the month left. So we'll see if we keep at it and keep going higher, or if we're going to be dealing with a little bit of a sell-off here. The month of December was a little rough, especially toward the middle. It was kind of a rough time, and the Santa Claus rally didn't really show up. So this year, I thought was going to start with some selling, but I was pleasantly surprised to see that there's actually some stock prices that were going higher. And now we're seeing a little bit of a sell-off more recently. The last 5 days, this is where I guess yesterday and today have been the worst days that we've dealt with. But overall, it's still good, considering that we've been up for 3 years. It's not a bad market at all. Some stocks do look expensive, and some stocks look pretty good right now. But I would say 2 out of 3 stocks are a little too expensive. So we got to be careful. We got to do our homework to find the diamonds in the rough, the ones that are going to do well. Let's check our research, check our homework, make good sound investments on stocks. So overall, the market has been a little rough. Looks like Bo is in. How are you? And Data Dog. So we can take a look at Data Dog. I am doing well. I've been fairly busy this 2026 and finally got a chance to live stream. And we'll take a look at Data Dog. Interested to see if that stock's been in rally mode. I know some of my software stocks have just been getting hammered, which is not fun, but comes with the territory if you're going to invest in stocks. Genetic Smite, good morning. Good morning. Good evening. Where am I? Herdo, good to see you, sir. Great to see you. Thanks for joining. So you guys let me know which stocks you want me to look at, and we'll take a look. If you're a paid member, it comes with the territory. If not, just buy a $5 super chat and I will handle it. Yeah, I would agree with you. Also, Dow has Chevron as a component, has some industrials as components. So that's been what it's been helping the Dow as well. So you are correct that the Dow has been doing better. And it kind of makes sense since we've been having such a good year. Since we had 3 consecutive good years for tech, high growth. The Dow has a little more of established companies that have, slower growth, good profitability, and most definitely year to date, these guys, the Dow Industrial Average is up 2.22%, and the S&P is just up about 0.5%. So it has been outperforming. Looking at the rotation, today's rotation, let's take a look at that. We had some, high-flying tech stocks really get sold off, Broadcom, Microsoft, but some software stocks really got smoked. Intuit, down 6%. I want to take a look at that later. That's one of my holdings. AppLovin, which, I was corrected by a member. I always think of them as a software company, but I keep getting that wrong. They're a communication services company because they do tech, ad tech, and um, and actually, Shadow Guy is the one that corrected me. I could have sworn it was a technology company. It's not, and I still have it listed wrong in my portfolio. By the way, I have to correct it. But AppLovin is a communication services company. I wanted to take a look at it because it got shellacked, down 7.6%. Meta getting smoked. Man, Meta showed up with a bad earnings report and they haven't recovered. But I keep buying shares of Meta because it's such a valuable business. Looks like big banks got beat up. I think it was the news around the limit on credit card interest rates. There's some story that the White House reached out to what senator was that? And she's a Democrat and she's really anti financial services. So she's going to, I think, collaborate with the White House to limit the interest that credit cards could charge. So I think that had something to do with the sell off here in big banks. Other parts of financials look pretty darn good. Even PayPal had a little rally today. Amazon took a step back. I took the opportunity to buy more shares. Travel services got hit. There's a big story out there, of course, Iran. And I hope the people in Iran are going to be okay. The news that I'm seeing is quite troubling and sad. And I hope that the number of people getting killed and injured is limited. I hope it doesn't get any worse. I hope it gets a lot better. But that's causing a lot of tension globally because Iran's a big oil producer. And that's what's been going on. And it's been driving oil prices higher. So you got oil companies like Exxon and Chevron going up higher because the oil price is going higher. So I wanted to take a look at a few oil companies. And Ricardo, who's a member, he came up with Cameco. So I wanted to take a look at that. All right. In healthcare, pharmaceutical looks pretty darn good today. Now let's take a look at materials. Look good. I heard silver went up a lot today. Silver's been on a strong rally. Real estate was higher. Utilities were higher. So these safe industries and sectors were in the green. Looking at the 1 week, the heat map for the 1 week shows that the place to be for the past week has been right here. Invested in energy, staples, materials. That's where it's nice, bright emerald green. Real estate pretty good, utilities pretty good, and then industrials were good. So this was the space. And some spaces were quite rough. Big banks, credit services, and software space. Look at that. That's probably the worst spot. Intuit down 13%, ServiceNow down 11%, CRM down about 10%, Adobe down about 10%. Whew, that is rough. So we're dealing with the little volatility here. No big deal. We can work through that. In fact, when stocks sell off hard, it's an opportunity typically. We've had some earnings. Earnings have started. We've got this morning we had Bank of America announce, Citigroup, and yesterday JP Morgan, Bank of New York, Wells Fargo. And I created a video for members. Take a look. I put some time and energy into that and did some research. So I'll let you digest that, consume it. And I don't have to cover the banks on this stream. We can go elsewhere. All right. So I'm going to get started on Datadog. And I've got some stocks that I wanted to take a look at later. Looks like Michael Anthony is on. Good to see you. Shadow Guy. What's going on, Shadow Guy? Excuse me here. All right. So, all right, cool. Looks like good chat going on there. All right. All right. So Datadog. So $43 billion market cap company. It's down a little bit. And let me get reacquainted with these guys. Datadog operates an observability and security platform for cloud applications in the United States and internationally. The company's products comprise infrastructure and application performance monitoring, log management, digital experience monitoring, continuous profiler, database monitoring, data observability, universal service monitoring, network monitoring. Okay. So it's a software application technology, pretty big company. And it sold off today. It's still selling off a little bit, not too bad there. It has a very high forward PE. That's going to be okay if they're growing fast. Analysts think they are discounted. Let's take a look at their growth. And when are they going to announce? They're going to announce on February 12th. So looking at the trailing 12 months, they're growing by 26.6%. That's very good growth. And they are fairly good size, $3.2 billion in revenue. That's good size. So that looks real good. And we've got margins. Gross margins look terrific. Free cash flow margin looks good. So these pieces look good. Looking at their forecast, we've got 31 analysts saying this is a discounted stock. We just finished the year that just passed, 2025. They grew at 28.86%. They're going to grow at 21%, 20.7, 21.4. And their earnings per share is really going to expand, bringing down their PE ratio, but it's still going to be an elevated PE ratio. Now, these numbers are good, but they're not fantastic. I think that you have some pretty big names. Like I think Microsoft is growing at about this particular growth rate, and they're huge. And their PE ratio is, I think, around 30. Let me double check that. And the reason I bring that up is we buy stocks in a market of stocks. We want to compare them against companies in the same industry or similar industries. In Microsoft for the 1 year, up 10%, 5 year up 112%. Has a forward PE of 27.6. So much lower PE. Let's take a look at their growth. Their growth, and I was mistaken, 15.59. But it's not too far from 21% growth. We look at their forecast. So we are in this year here, that's going to end June 30th, 2026. They're growing at 18.27, and then by close to 15, 16, 13. So not quite the same percentage, but you see the number is massive, almost 100 times bigger than Datadog. So Datadog's growth is not overly fantastic. And I think that's what's troubling investors is this one's kind of right in that middle. It's not a high growth stock, but it's not a slow growth stock. It has very good gross margins. It has very good cash flow. So when we look at, we looked at their forecast. They're going to announce on February 12th. Let me see if I've got an evaluation for Datadog. Here we go. So I take a look at this on the 3rd of January, discounted by 16%. And that's not a wonderful discount. That's not a great discount. It's not compelling. We are buying a company's shares in a market of stocks. Let's go over to my watch list. And if you're interested in this watch list, it's available to members in the terminals that I've created for super investors as well as advanced investors. They get a terminal that has this watch list in it. So you get to take a look at the stocks. So what I'm going to do is I'm going to look for Datadog and I'm going to compare it to its Similar companies. So here's Datadog, and it's discounted by 16%. Akamai, and I wouldn't recommend Akamai. It's not growing. But you have similar company and Dell. Uber's discounted way better. It's a technology company. We have Cisco has been a nice pickup for some people. It's discounted by 19%. Xiaomi's discounted by 20%. So you have a lot of discounted stocks, about the same amount. But I would really like to see, really compelling situations. And Datadog just doesn't do it for me. It's not quite attractive enough. It's a small company. I've got to be careful with small companies because they could really surprise me. Here we've got like Adobe's discounted big time. Path is discounted. Nice software. They're really small. They're discounted. So a lot of choices in tech and in software. Yeah. So there's a lot to look at in technology, software companies. And for some reason, software companies have been, you know, deemed to be undesirable by the market. And I'm not agreeing with the market that AI is going to replace software companies. I just don't believe that. I think that software companies have a unique, feature and functionality for that particular need, and customers buy it because it saves them time. It enables them to manage data, manage businesses, manage classrooms, and that isn't going to be replaced very quickly. I think it's going to take a while. And but the market's going to do what it's going to do. Datadog is not compelling enough for me, but that's where I'm at with it. 16% discount, just not enough. And the big difference is that analysts are giving Datadog a very high PE ratio. Like if I change the PE ratio to 50, you know, I'm closer to what analysts are saying, but you know, I can buy Microsoft for 28 PE, and I'm not going to pay more than 25 for Datadog because it's a small cap, and that's where I stand with it. So thanks for asking about that, Bo. It's an interesting one. We're seeing a huge sell-off in software companies for sure. Okay, so one of a member came up with this stock, which I don't think I've covered yet. Cameco. And he did a lot of research and put it on the Discord. So, Cameco Corporation provides uranium for the generation of electricity. It operates through three segments: uranium, fuel services, and Westinghouse. Okay. I think he had brought this up before. It's up 2%, up 21% in the month. Wow. Freaking rock star, huh? Wow. Looks great. This was a great entry point back when we had that big sell-off due to the tariffs. This is a $48.2 billion market cap company. Let me take a look at their website. Okay. So the uranium will be used for nuclear, and nuclear has received a lot of attention to create power for a lot of these new data centers and the power necessities. I mean, we have an EV demand now too, electric vehicles. Speaking for myself, I bought an EV car in September, so I put more load on my house. In fact, I have solar panels on the roof of my home, and it was pretty much break even at the end of the year. But now with my EV, I'm not breaking even anymore. I'm consuming more than the power I'm producing. So that's an example of the additional demand that we have out there for power. And Cameco is really, really doing well. Now, valuing this company, let's take a look. Forward P is 85. It's very high PE. Analysts think we're close to fair price. The growth of the business is 23.88%. And the margins are not what we just saw with like Datadog, 80%. They're at 36% gross margin. They do have a profit of 15%. In the past, they were single-digit profits, and they were unprofitable for 2020 and 2021. And they are free cash flow positive right now. So they have about $1 billion of free cash flow. And this company is producing or procuring and then reselling the uranium. So I don't think those margins are ever going to move much from there because it costs money to mine it. You're dealing with a commodity, with a material. This year, they're supposed to grow by 8.6%, which is not matching that high PE. They're in a space that's very popular right now. You know, uranium, nuclear power, very popular. The theme is there. The story is in. But the fundamentals are not overly exciting. I'm more into numbers than I am in words. And the numbers are not all that exciting. The earnings per share of $2 per share. Forward PE ratio of 74 is really high. If I'm going to pay a 74 PE ratio, I'd like to see like 50% growth for a low margin business like this. I'm not anywhere near that. And next year it'll be 2027, 9.5% growth, and then 5%. So those are not impressive numbers. So I would be careful with this stock. The best I could do is value this company at, let's call it 30 times free cash flow. Brings us up to about $30 billion minus its debt. Let's take a look at its debt level. They don't have too much debt. So all in, the best I can do is about 30 billion, which means that this stock is priced way too high by about 18 billion. So that means 18 billion. Yeah, it's priced 40%, 60% too high. And that's just from a fundamental perspective, looking at the business. What's wrong with let me try to phrase that. What's driving down my valuation is the lack of growth. Okay, this is growing nicely. But then when we get to the forecast, this is one of the best features of stock analysis, by the way, is this forecast. How am I going to pay this kind of PE ratio when I have a business with single digit growth with low margins? So you have a low ceiling on margins, you have low growth. So I get that the story is nuclear is making a comeback. Got it. But when I look at the numbers, I'm concerned. Here we have in the quarter that was closed on September 30th, they actually had a contraction. And it's expected they're going to contract in the fourth quarter. So they're going to announce that in probably a month away from that. So how's the market going to handle that? Well, right now the stocks have been rallying. Then they're going to get back into some growth. So not the right stock for me. And it looks like the market really likes it. And I will sit this one out. That's Cameco. Thanks so much for Ricardo to bringing that stock up. You know, I don't invest in every industry that's out there. Some industries don't make sense to me. Some industries just seem that like they're too expensive and they're just not my cup of tea. Cameco is probably in the category of it just doesn't make sense to me. I'd rather, if I'm going to go into materials, I understand ternium, I understand oil companies, but I just don't understand how I'm going to pay up for a stock like this. The fundamentals just don't tell me I'm making a good decision. So that's my point of view. All right. So Covered Caneco. Thanks again, Ricardo. Good research on that. Keep bringing that kind of research, please, sir. Kurt, good to see you. You know, you're the second person that's brought up Dave. Mike, the dividend investor guy, he not slacked me, he sent me a message on Discord. Let's take a look at Dave. Ben 10. You want to look at CDLR. Let's take a look. Good to see you, Ben 10. You want to look at STEM, STEM. Got it. All right. Man. And then Celsius. Man, Celsius has come up a few times over the last month. And the fundamentals last time look good. I'm not a big beverage, investor. And we'll take a look. All right, let's jump into Dave. Now, I bought some additional shares of Dave today in my older son's portfolio. I think the business is a good one. It has a very good idea for the future. It's a provider of financial products and services through their platform. And so they're a new generation banking solution, financial services company, and they are growing very fast, as you'll see in a little bit. I like that growth. Growth is really hard to come by. Yet, as businesses get bigger, they stop growing because it's hard for them to grow. But innovative companies like Dave come into a market and they start picking up either portions of the consumer market that was underserved. So they're just picking up good organic growth, and they take customers away from the established players, these, legacy banks. And these guys have certainly been doing that. When we look at Dave, let's go over the things that I think are positive and negative. So market cap, small, 2.5 billion. It's really small market cap. Over the 1 month, it was doing well for a while, and then it's really slid down from 239 down to 185. Wow. Down 21% over the 5-day. Yikes. That's rough. This is what attracts me to the business, is growth. Real nice, high growth. And this is as of September 30th. They're going to announce their earnings for the fourth quarter of 2025 on March 2nd. So we'll be able to hear what they're doing on that date. Now, the way that this business is put together is they're not acting like a bank necessarily. Banks tend to have net interest margin as their primary profit engine. These guys are transaction based. They're charging transactions. And the new generation financial services companies are doing that. Like if you look at the buy now, pay later model, they're charging a fee, but they're not charging interest. So that could be more lucrative for the provider of this short term, I'm going to call it loan or credit. Although they're not lending money, they're charging a transaction. And their profit margin is really good. So these numbers to me look real good. They don't have a lot of debt, and analysts think it is discounted by a pretty good margin. If their forecast is correct, they grew really well in 2025, but they're seeing a real slowdown here. I think this is where the problems lie, this slowdown. And I think what hit Dave, which may be kind of misplaced by the market is that the White House reached out to the senator, I think in Massachusetts, and Elizabeth Warren. That's it. And she's a real bulldog against corporate America. So I think there might be some pushback on high interest rates. But I don't think Dave charges interest rates. They don't do net interest margin. Credit card providers, like Capital One, that's the biggest credit card issuer. Yeah, they may have some problems, but Dave's going to continue to operate as intended. But this slower growth is a concern to me. You're going from 56 to 18. What's causing you to slow down? Why can't you keep growing? They're not that big. So my question is quite rational. It looks like for the fourth quarter of 2025, they're going to grow by 54.8%. Then the first quarter should be good here, 36.4. This stock will rally higher if they can keep their growth higher. So I'm going to be looking at this line on their earnings. And if they can guide next year and say, hey, we're going to keep growing at 30%, whoa, you're going to see a real pickup to the stock. For now, investors are playing it safe. If you look at how the stock's been tracking, it got bid up coming out of April, and it's pretty much gone sideways, consolidated. It's just been going up and down along this channel here. So for me, I think Dave is a good, let's wait and see stock. We got to hear from their management. It really got shellacked today. It's not an obvious, opportunity where, man, this thing is set to really go higher. I have a valuation for Dave. When I look at the numbers, on financial statements, the numbers kind of, to me, they kind of tell me the story financially. And this one here, it still looks really good because they cash flow really well. They're a fee-based business. They have a strong discount of 61%. Wow, that is pretty strong. That's pretty darn strong. So, man, looking at these numbers now, I'm kind of flipping on you guys. I'm thinking Dave's looking good. But when's the market going to turn the other way? I think I would still wait for the earnings to come up, but Dave is looking pretty darn good. It's looking real good. I think the numbers, the profitability behind the business, it's an attractive business. So I would actually say Dave's a buy. I bought it in my son's portfolio. So I did put in a buy order, not for my portfolio, but for his. And FYI, he's 25. So I put him into growth and he's killing it. So his portfolio is doing great. So that is Dave. It looks good. It's risky. It's small. But boy, this thing can really rock it up. If they have a good news earnings call or a lot of good news released on the next earnings, this sucker's going to fly up. And it's already pretty much kind of come down quite a bit. And I don't see it going down further because the fundamentals are really good. All right. So let's go into CDLR. And CDLR, I think, is a healthcare company. No, I got it way wrong. Cadeler, together with its subsidiaries, engages in offshore wind farm installation and operations and maintenance services in Denmark. The company engages in the transportation, installation, and maintenance of offshore wind turbine generators and platform topsides substations, maintenance of offshore structures and platforms. All right. I remember looking at this. And this type of energy production makes a lot of sense. This is totally clean energy. These guys are installing these turbines, these wind turbines. These suckers will produce power and then give it to its clientele. And these guys own these assets to do the installations. Really interesting that we're doing this. But it makes sense. I mean, we're drilling for oil offshore. We've been doing that for a while. Looks like they're installing these turbines in somewhat shallow water. It doesn't look that deep. Okay. And when we look at the fundamentals behind these guys, it's a $1.9 billion market cap company. It's been going sideways. Huh, interesting. The PE is really low, 6. Where are these guys headquartered? In Denmark. Okay. Very good business. I say very good business because we need a lot of power. These guys produce clean power. I think that's a win-win. 1.9 billion, revenue of 632 million, low PE, no analyst is covering it. The growth is pretty darn impressive. Quarterly, still impressive. So they've been earning a lot of projects to do installations of these wind turbines. And they are profitable. So the profit margin, the gross margin is 63%. It's very good. And then profit margin of 50%. When I look at construction companies, they tend to have really low gross profit margins, which is kind of a limitation for me. I like to see higher margins. These guys have been growing their margins. Nicely done. It might be that they service these turbines, right? They're out there generating power, but somebody has to service them, repair them. And that's where they might be getting into some contracts, some maintenance contracts. That is a reoccurring revenue that helps them have very good margins and not have to go sell every single piece of business that they're going to bring in. They could just have a reoccurring revenue. And the profit margin looks terrific. Now, their free cash flow is not good, probably because they're growing so darn fast that they have to put a lot of money into that business. Let's take a look. And I'm going to look at their actual website and see if they have a financial statement. And the reason I'm going to do that is stock analysis does a terrific job, but it just doesn't get every import of a financial statement perfect. So I want to look at their actual financials. Where are your financials here? Let's go here. So we got SEC filings. That is what I want to hear. Is there a 10K out there ready for me? Schedule D. I guess for foreign companies, we're going to deal with something else. Let's see here. I can get there. Oh, it's another way. Financial results. All right, this is going to do it here. All right, bear with me. I'm trying to get to their financials. And here's their backlog. So let's go through this together. Okay. You see the very strong growth going from 162 to 452. Very good. Profitability just went through the roof. It went up like 8x, if not 9x. That's big, big growth. Cash flow from operations from 44 million to 285. Wow, incredible. So the backlog, how many, let's see here. So they have a pretty strong backlog. What was their revenue? So the revenue right now is 538 million, trailing 12 months. And when we look at their backlog, so they have roughly 2 years of backlog. No, actually, I'm sorry. So this is within a year, so they would be able to grow at 683. And after a year, 1.3. So they have backlog, I'm going to say, for 2.5, 3 years. Strong backlog. Right. And I see you, Bo. Give me a minute. I'm going to get to your comment. Okay. So we've got, I'm not worried about their profit and their revenue. We'll look at their statement of cash flow. Okay. Change it. Here we go. Here's statement of cash flow. So here's the section that's most important is cash from operations. And the first, you start with how much money you made or lost on that income statement. In this case here, they made 232 million over the last 9 months of 2025. Depreciation gets added back in. Okay. So trade receivables, their customers owe them money and it went up. So that's a decrement. And they're going to be paid that because they just provided terms to their customer. So cash from operations, that's really impressive. Super impressive. And they're adding a lot of equipment. They're probably putting either additional ships into their fleet or putting more equipment on those ships to the point of 930 million. So that's what took them into the negative on free cash flow. But I'm still good with this number. It's just they're growing right now. That's why this number looks the way it does. So I'm impressed with this business. I think it's a good one. Let's take a look at one more metric here. Make sure we don't have a bunch of debt. And they do have some debt, 1.43 billion. Debt to EBITDA 3.75. I think that's okay because they're in a growth mode. They've had to buy equipment, put it into service. They're generating a lot of revenue, a lot of profit. That operational cash flow is good too. Once they've built their fleet and have all the assets they need and they expand, I think we're going to be okay with that debt. So Cattler looks really interesting. I like the growth. We don't have a, do we have a forecast? We do. So the growth in 2026, 69.44. Then they're going to grow in 27 by 36. Now, if they don't fill in that backlog, they're going to have a contraction in 2028. I still like these numbers a lot. These are good numbers. Their forward PE is 19.3 and then 13. So I would think that their business is going to keep growing because the demand for power is there. And I don't know why countries wouldn't want to take on this type of technology and solution. It wouldn't pollute their air. I could only see positives from this business. Let me see if I have a valuation for these guys. I see Peter's out there. Good to see you, Peter. And yeah, you want to take a look at a couple stocks. I'll get to that in a few minutes. And here is CDLR, and I'm using a very high discount rate because it's out of my home country. It's in kind of a risky business. You got ships installing wind turbines, but overall, if you believe in this, the fundamentals show that it's a good investment. I'm not an investor. This is out of my zone of expertise. Um, I like what they're doing a lot, and would consider this a good buy stock. But you got to be really comfortable with their business. It's not just a, hey, the numbers look good, let's go for it. And my apprehension might be what the market's thinking collectively, right? Hey, we don't know wind turbine installation. We don't, it's out of, the US home country for a lot of investors. So that's what's going on. Now, I would be a hawk on their earnings. Really study them up because this is a small cap. It's not going to get every single investing analyst, on the stock. So these guys are set to report toward the end of February, early March. So if you're interested in Cattler, I would really study their earnings. Maybe you get an advantage there, an information advantage. All right. So Ben 10, I've got the stocks you want. Let me just note what Peter wants here. Can you check EXE and compare it to EQT? Yeah. I'm going to put that on the list, Peter. And Bo, you want to take a look at so you want me to look at Mama, if I'm following this right. So you want to look at Mama, very small cap. And then what's my opinion on investing in Venezuela? Exxon seems okay. Yeah. So I own Chevron, and I am familiar with what they're doing in Venezuela. Now, there's a lot of hazards for like a company, even Chevron. Chevron's been there, and the hazards are that I think it was in the 70s or the 80s? Got it. Okay, you're giving me an opinion. Yeah. And I'll comment on this and then I'm going to get to Mama. So Exxon is probably nervous because the Venezuelan government nationalized the oil extraction and oil pipeline assets from foreign companies. That's never good because then you're going to become uninvestable for the future companies. So Exxon might be nervous about that. Like, hey, we don't want to put, I don't know, $1 billion into Venezuela or $5 billion. And then the government decides that they're going to nationalize them. Nobody would ever want that. So I get that. But you're going to have a little bit of backup from the US government. So Chevron's already in. And Chevron was doing business with Venezuela for quite a while, even after Venezuela became pretty hostile toward the U.S. or vice versa, if the U.S. became hostile toward them, or both. And Chevron did do well with that type of model. So Chevron does have a pretty good advantage of Venezuela if things are opened up there. So, okay, so all right, perfect. So yeah, my choice would be Chevron because they have the advantage. And I actually had Chevron as a stock that I wanted to look at. Chevron and Exxon to me are very close, similar. This one's done well for a month, but it hasn't been a superstar stock. It hasn't. Over the 5-year, if you consider that you could have bought when you had some really good lows coming out of COVID, yeah, you're doing well over the 5-year if you include the dividend. Because if you include 5 years of dividends, you're up to 100% rate of appreciation. But over the 1 year, not so much. You're doing okay, but okay isn't good enough. If we keep seeing oil prices go up due to this Iran conflict with the US, or the US, potentially taking action toward Iran because there's a lot of trouble in the country if the reports are correct. That's driving up the oil price, and if oil prices go up, that could really be profitable for Exxon and Chevron. Now, Exxon's position in Venezuela, would it hurt it? Not short term. Whatever Chevron or anybody else that invests in Venezuela, whatever they invest, they're going to see the fruits of that in 3 to 5 years. It's not an immediate thing. So Exxon's, stock is going to keep working. If oil prices go up, Exxon's going to be a terrific stock to own. It's a real good one. It was one of the top dividend stocks that I put out there on a video to members. So if I were to look at an investment for the next year, I think both are good. I think Exxon's a little better. Let me show you why. So Exxon's performed better over the 1 year. It pays a nice dividend. Chevron has a slightly bigger dividend. Exxon is bigger. In general, Exxon has outperformed Chevron. They just have more profit out of their holdings and the way they produce oil. This isn't going to change. Exxon's really good at the oil business. And they got to number one for a reason. So if I was looking at a 1 to 2 year horizon, I'd probably give the advantage to Exxon. Say that stock's probably going to do better than Chevron. And Chevron's going to benefit over the long term with Venezuela. So the story is going to be out there that, hey, the reserves in Venezuela are going to be available to U.S. companies. That could be a real good thing for the next 20 years for the right oil company. And I think Chevron can capitalize on that. So that's your choice. Long-term, short-term. If you want the long-term winner, Chevron. You want the winner for the next 2 years, Exxon is my opinion on that. All right, so Mama's Creations. Mama's Creations, together with its subs, manufactures and markets fresh deli prepared foods in the United States. The company offers beef and turkey meatballs, meatloaf, chicken, sausage-related products, pasta, and rice entrees. Olive products, hot bars, salad bars. Okay. Packaged foods, consumer staples. Mama's Creation. I don't do a lot of shopping, but I've never noticed these guys. Maybe they're not on the west coast of the U.S. It looks good. Yeah, it looks really good. Okay. So it's a food company. And these types of foods, by the way, are a really good idea. It's not necessarily like TV dinner, overly salted foods and so forth. So I could totally understand the consumer in the US wanting this type of option, a healthier option that's easy to prepare. 'Cause people in general are really busy. The company for the 1 year, it's up a lot, 100%. 5 year, wow, look at that. These guys were tiny dollar stock. Now they're up to $13. Phenomenal. Forward P is 63. Analysts still think there's a discount. The 1 month, it's had a pullback. All right. It's growing nicely at 29%. Looking at the quarterly, the last quarter was a real booming quarter, 50% growth. So their product is being sold. It's being adopted really well. People tend to like it. That's why they're growing really nice. They're still relatively small, $151 million in revenue. So they're not real big. Free cash flow, $6 million. And this is where food companies become less desirable for me. It's a gross margin of 25%. Well, it's not overly exciting. And they're single digit profit margins in this low single digits. And the free cash flow, 4%. Not very good. Now, their free cash flow may be limited because they're growing. So they're buying more equipment, putting it into production. So let's take a look. 5 analysts cover this stock. They believe there's still a discount available. Mama's is supposed to keep growing. It looks like their year is going to end at the end of January 2026. And then we're going to be on to 2027. Their growth is going to continue at 28.8%. And their PE ratio is 58. From there, we're going to see a slowdown if these analysts are correct. That would be a concern. If they slow down, you're not buying a growth stock. You're buying a good growth stock, but not a pure play 50% grower or anything like that. And their PE ratio is still really elevated for a very low profit business. I really focus on profitability, cash flow, and growth. If you get that combination of a really good growth stock with very good attributes when it comes to profitability and cash flow, you got a gold mine. This one here is actually concerning to me. I think it's been bid up because it started to grow. Excellent. But is it going to have one of these situations where it grew? It went from 20%, 15% growth to 98%. And then it couldn't grow. It was like it captured some kind of new market. And then, okay, it plateaued. And then it started to grow again. Is it going to plateau again? Maybe. If it does, I think stockholders are going to get hurt. So they just do $6 million of free cash flow right now. Let me take a closer look at their cash flow statement. So the trailing 12 months cash from operations is 7.3 million. So it's really low free cash flow. So if I multiplied that number with their growth, low margins, I'd be paying like 20 times that number. And that would get me to about $140 million of value less debt. And they don't have any debt. Very good. So 140 and their market cap is 550. So this is uninvestable for me. It's just the valuation has gotten way out of hand. Investors are reading that top line growth and getting really excited, but I think there's going to be some pain involved for investors if these guys stop growing fast and you're left with, hey, all we have is a slow growth, low profit business. I think it's going to be pretty harsh. I think it's going to really inflict pain on investors. But it has been impressive how they've gone. It's a small cap, so it doesn't take much. Doesn't take many investors to get this stock going. And it's up 586%. Incredible. But let's think about, what is possible for Mama. Are they going to become a giant company like, I don't know, Kraft Heinz or, a company like that? If you look at those businesses, they've all struggled. It seems like they do well for a couple of years and then they struggle. They don't have a lot of profitability. They don't have a lot of room for error. So for me, it would not be an investment that I would consider. But good luck to anybody that wants to enter it. And but I think it's a sell for me. Thanks for asking, Bo. That is an interesting one. Let's take a look at, I think Peter wanted to look at EXE compared to EQT, which is a natural gas provider. Let me close some tabs here, kind of make my workspace a little cleaner. EXE, Expand Energy Corporation. So these guys are pretty much going sideways for 1 year, for the 5-year, up nicely, coming out of COVID. So we had really low per barrel oil prices coming out of COVID. Energy prices were really low because we weren't using all that much energy when everybody was sent home. And it was easy to see stocks climb out of that era because if you go max, I guess these guys IPO'd back here. But if other companies, like let's go with Chevron, you see that COVID, this stock was at $123 a barrel per share, and they dropped to 83 during COVID. And then from 83, they're up to 167. So yeah, if you bought Chevron during COVID, you've doubled your money. Nicely done. But we're not going to see a big pandemic for a while and affect energy prices, commodity prices, as well as stocks. So these guys here, Expand Energy Corporation, operates as an independent natural gas production company in the United States. The company engages in acquisition, exploration, development of properties to produce oil, natural gas, and natural gas liquids. It holds interest in the Marcellus Shale in the northern Appalachian Basin in Pennsylvania, and the Marcellus and Utica shales in Ohio and West Virginia, the Haynesville and Bossier shales in Louisiana. So they're doing all that shale. They're doing fracking. Fracking's more expensive, but companies have gotten really good at it. And the cost of extracting oil has really gone down. They've gotten so much better at extracting the oil. I heard a really good interview from the Chevron CEO, and he talked about how the cost has really come down. It used to be that an oil company would have to have a per barrel price, this is a while ago, $60 per barrel to be profitable. Now they're down to like $30 per barrel. If there's a $30 per barrel price, which is really low, they can make a profit because they've gotten a lot better at extracting. So once they find the oil, the way they extract it is way more efficient. So that's Expand here. They are a $24 billion market cap company. Forward P of 12.7. That doesn't look too bad. 5-day. So what's going on here? So I have observed that natural gas producers have been selling off and oil producers have been rallying. So if we look at the 5-day, these guys have been going up, going down. Natural gas, the commodity, is going down. And crude oil prices are going up. And that's the reason for it. Looking at their, look at this, must have been a merger or an acquisition, because this is hard to believe. And the stock price should have been just roaring higher if they did have that kind of growth. So these guys are, look at that. They've got a big number here, came down, and now it's up again. Man, these numbers are hard to follow. They don't track in a nice, smooth trajectory, either upward or downward, right? It's kind of, you have peak years followed by contracting years. And for me, it kind of takes away confidence Doesn't instill confidence in the numbers. So free cash flow looks good. Okay. Free cash flow margin, 13%. Just these numbers they don't exude confidence, right? You look at numbers like here. Let's take a look at these numbers for the last 4 years. Exxon. Free cash flow, free cash flow, free cash flow, free cash flow, free cash flow. Nice solid numbers. This is COVID. Okay. So yeah, COVID hurt them. But you have that type of consistency. Now, these guys are dealing with a commodity price. And even with that, and they're a big producer, the commodity prices come down. So we're keeping track of that. So these guys, I don't think the commodity prices more than doubled. So there had to be an acquisition or something here. So 19 analysts cover them. They think it's discounted based on earnings per share. The growth doesn't look all that exciting. And we are in this 2025 year. Their PE ratio is going to be really low. This company requires a lot of homework. And the way that I had a negative point of view on their numbers is what other investors are going to feel. Because when you look at these numbers, you're like, whoa, what's going on here? Up and down. And who knows what's going to happen next? So be aware that I think we got to keep that in mind, where if a company has a really good look to them through their numbers, like nice, smooth, upward growth, nice, consistent growth, they have a good business plan, the investors are going to be more inclined to buy that stock versus one that could surprise you. Nobody wants to be surprised, especially to lose money. So this one here is kind of a rough company to analyze. And it looks like they are not going to have stupendous growth going forward. 2026, small growth. 2027, small growth. Nothing stated there. Their P ratio is going to be low. So let's see if they have debt. They do have some debt, $4.5 billion. They have free cash flow of $1.4 billion. So their debt to EBITDA isn't a problem. I think they're going to be okay. So what would I pay for EXE? Probably 14 to free cash. No. Yeah, 14 billion to 21 billion. I'm multiplying that number times 10. And they're above that. This just doesn't do it for me. I think it's too much risk for not a lot of reward. EQT, I started buying into it, and I've had recently, like today, I finished selling it because it just wasn't making any sense. I took a position, I dollar cost average, and what I thought would be a good idea would be to buy into these guys after this pullback, because natural gas is one of the most popular ways to create electricity, putting it into turbines and then burning it. And these guys kept selling off. It wasn't a very strong valuation to begin with, so I sold it. Forward P is 13. They're discounted according to analysts. These guys do have pretty decent numbers. They had a pullback here a year, but the numbers look good. And their valuation looked good. It wasn't overly discounted, but this is one stock that I decided to sell. Even after the pullback, it's only discounted by 28%. So for me, I got out of natural gas. I didn't get hurt too bad. I lost a little bit of money on EQT, not a lot. And I'm just going to stay out of it. If in fact, Peter, I really appreciate you prepping for the investor call we had Sunday. And I noted a few things that I thought I could do better. One of them was to be more concentrated in my positions. That was one of the influences behind selling EQT. Sell it off, be more concentrated within energy companies. And that's what I did. So I sold off EQT, and I would not buy, this would be a sell for me. When you buy a Chevron or an Exxon, you're buying it an integrated company. Chevron does do natural gas. They do crude oil as well. They do a variety of things. And that in itself gives you that diversification where it's going to be lower risk. So that would be my play instead. So thanks for asking, Peter. Good to see you. All right. So it looks like we are on task. Handled Bo's questions, handled Peter's questions. I think Ben 10 had a few requests. Let's take a look at STEM. What is STEM? STEM Inc. STEM Inc. provides artificial intelligence driven software and services that enable its customers to plan, deploy, operate clean energy assets in the United States and internationally. The company offers OEM energy storage systems, software, and edge hardware devices. It serves energy traders, asset owners, independent power producers, community choice aggregators, off-takers, renewable project developers, engineering, procurement, construction firms. Okay. So this is STEM, huh? I'm reading this, guys, so bear with me. So they do integrated solution for your solar and storage data. Okay. Okay. So they're in the clean energy, focusing around solar. $166 million business. They're not profitable yet. They're not growing. This is a concern. Now they are beginning to grow. So they had a pretty big contraction here. It was a string of 4 quarters where they contracted, and now they're growing again. Now the solar industry took a pretty big hit when President Trump was elected because he didn't support like clean energy and stuff. But the solar companies, some of them have continued to be really profitable and grow because solar energy makes a lot of sense, especially if you have, high sunshine states, the Arizonas, Nevadas. I mean, it makes no sense not to have solar. If you're in Las Vegas, you have solar. Just you have to pay so much in air conditioning. You want that solar power to help you power up that air conditioning. And these guys are growing. I think they're on the rebound. Let's take a look at their overall gross margin. So their gross margin is pretty low. I guess they're doing the storage batteries and so forth. If they are, that's why they're so low gross margins. But that means that they don't have a lot of room to make money. In fact, they're losing quite a bit of money. And they are cash positive, but it's been inconsistent. Okay. We have 5 analysts covering it. Slow growth this past year because that a combination of those bad quarters. Look at that. They were 461. Then they had a real big contraction. They're going to grow slowly. Huh. Balance sheet. They have some debt, $323 million of debt. Yeah, this one here, I can't do much with. They don't have free cash flow. They don't have profit. They have pretty good debt load. For me, it would be a pass. The market's not convinced that, hey, these guys are going to be a great stock. It did well, 47%, because it sold off so much. Study their next forecast. If you think they're going to start consistently growing, you got something. But boy, it went real low. Got down to $7 per share. If their technology was awesome, they should just keep growing. Some of these solar energy companies, what's the one I want to look at? Is it Enphase? No, I know a couple of energy companies. I looked at them a few weeks ago, and some of them are doing well. So let me try to find that for you. So stocks. There was a search that Stock Analysis has. It's either clean energy or solar. So G Vernova, yeah, that one's doing really well. Consolidated Energy, Bloom Energy. Was it First Solar? Yeah, this is it. First Solar. First Solar is doing well. They do components. They do some of the devices that you use. So not the whole solar space is dead. So STEM is just not getting it done. Something's going on there. All right, cool. All right, guys. So why don't we end it there? We're going to go over Celsius and then we're going to end the stream. That'll be the last request. And then we'll take a peek at what earnings are coming up tomorrow. So Celsius has been really moving higher, and my valuation of it has been positive. I've been saying that the fundamentals look really good. I'm not the first one to invest in beverage. It's not my favorite industry. It's sugar water with a little caffeine. And I'm sure some other stuff. And people love this stuff. I like coffee, but other people love it. This stock's been a real nice growth stock. If you look at the longer term chart, it did really well for a while, and then it just collapsed. And it's really rebuilding itself. So I think it's been looking really good. And we've covered Celsius a few times. I've been saying that the fundamentals look good. I thought I had Celsius out there. I guess I don't. I didn't save it. But overall, the growth in Celsius looks good. Growth has been good. The forecast. For 26 looks good. It's going to keep growing, slower growth, but still good. And its profitability is going to expand. So the fundamentals look good on Celsius. I don't like beverage companies. They just tend to not be exciting enough for me. I'd rather invest in pharmaceutical, biotech, technology, communication services. I'll leave these up for somebody else to invest in. All right. So what's coming up on earnings tomorrow? So we got TSM before the market opens. I'm going to try to do a video tomorrow on TSM for members and release that. We got some more financial companies, Goldman, Morgan, BlackRock. So I'll focus tomorrow morning on TSM. And I know that there's members out there for you, advanced members. If you haven't had a chance, take a look at the terminal I created for you guys. The valuations are updating real time. So when you look at this valuation, for example, which one did we go over today that I don't think I updated anything on the stream, but Citi as an example, I updated this morning. So you have the most recent valuations. So I created this for you, advanced members. You can have real-time research. When I create it, a few seconds later, it updates. So take a look. I hope you find it useful. And then here's the watch list. Boom. All the stocks that are on the watch list are here. For super investors, it's even nicer. It costs a little more money to go with super investors. The watch list is here's my portfolio. You get access real time to my portfolio, what I'm doing. I chart my portfolio based on the weight that I have in a stock, what sectors I'm invested in, actively what I'm buying and selling, and then that watch list. So I listed out by, stocks that I think are really good buys that I'm looking at, days on the list that came up today. So not a bad time for me to start buying into Dave. Make myself a note. So take a look at that, super investors. I created these terminals. Give me some feedback. Let me know if there's something you really like and something you really don't like, or maybe something you'd like to see. Love to keep building those terminals to make them valuable for you. And that is it, guys. Let's tune in tomorrow. I will try to stream in the evening again. Then I'm going to try to stream on Friday morning. And hopefully I get a chance to stream with Daryl. I've been a little MIA. I had heavy travel last week, so I couldn't really stream. Then this week, I've had some major plumbing issues at home that I've had to tend to. Let me tell you, plumbing is not fun and it's not cheap, and I just got to get through it. But we're not a good place, and I think we see the light at the end of the tunnel. So everybody have a terrific night. Thanks for tuning in. Let's see where this market takes us. Have a good night.